The second module in this course deals with the basic financial statements and understanding the accounting rules. More specifically, the topics we're going to cover is what are the four basic financial statements, how are these used in making management decisions, what is an annual report, what's an audit opinion, what are basic accounting principles, and who makes the rules for accounting and reporting. In this module, you should have in front of us the annual report for the AmerisourceBergen Corporation that appears in your reading handouts. This is the annual report of this company for the year 2010. There are four basic financial statements: the balance sheet, the income statement, sometimes called the statement of operations, the statement of changes in stockholders' equity, and the statement of cash flows. I will go through each of these and explain what they are. You should actually open your annual report to the financial statements which appear in the second half of the report, and have these statements in front of you as we discuss them. First, I'd like to talk about cash versus accrual accounting. What you do in your personal life is called cash accounting. In other words, if you receive a paycheck, you record it when you receive it from your employer as income. When you write a check to pay out for your rent or for your utilities, you record it in your checkbook on the day that you write it. This is different than accrual accounting. In accrual accounting, we actually record the transactions when they occur, both for revenue and expenses. And I'll go through this in more detail later. First, let's talk about the balance sheet. The balance sheet refers to the accounting equation, which is known as assets equal liabilities plus equity. So everything we see in the financial statements balances between the assets and liabilities and the equity accounts. Assets represent the things that companies own. Liabilities represent money they owe to others. And the equity is the money that has been advanced by the owners. So if you look at the equation, the assets either have been acquired because we have borrowed money from other people and issued debt to do that, or we have issued equity and got investors to invest money in the company to buy the assets. You will notice on the balance sheet it has a single date at the top. That's because a balance sheet is a snapshot of the company's financial position at one point in time. December 31, June 30, September 30. Whatever it happens to be, is at midnight on the last day of the accounting period. The statement of income, sometimes called the statement of operations, has several categories. The sales or revenue line on the income statement represents what has been sold as a good or service. Cost of goods sold is what it cost to make or purchase the items that were sold. So if you manufacture the item that you sold, that is the cost of goods sold. If you purchased the item from another vendor and then turned it around and resold it, that is the cost of goods sold. Operating expenses are the amounts that are incurred during the period to make the sales. Such items as administrative expenses, selling expenses, other general expenses. Quite often, the operating expenses are referred to as selling, general, administrative, or the acronym SG&A. Now, the income statement is different from the balance sheet in that the income statement is a panorama over a period of time, from the first day of the year to the last day of the year, or from the first day of the month to the last day of the month. So we see the terms for the year ended such and such, or for the month ended such and such, because it's referring to all the transactions that occurred in that period of time. The statement of changes in stockholders' equity reflects the capital stock that has been sold and the amount of earnings that have been retained in the business and not paid out to the shareholders, which is known as the retained earnings. Also, you will see the item treasury stock on the statement of changes in stockholders' equity for the AmerisourceBergen Corporation. Treasury stock is stock that the company has gone out into the open market and purchased, and they are retaining in the treasury for some future use. They may choose to issue this stock in a merger or acquisition of another company, or they may ultimately retire it. It is basically an investment the company has made in their own stock. The line additional paid in capital represents the amount the stock was sold over and above the par value of the stock. So if the par value was $10 a share and the company sold the stock for $20 a share, $10 represents the capital stock equity and $10 represents the additional paid in capital amount. The statement of cash flows is the baby statement. It came about in its present form in the late 1970s. Prior to that, there had been a number of iterations or attempts to present the cash flows in different formats, but it wasn't until 1978 that the Financial Accounting Standards Board prescribed the present format and made this statement one of the four basic financial statements. It is broken down into three categories. Cash provided by operations. What is meant by cash provided by operations is this represents the cash that is generated from operating the company, the net income, and the changes in the current assets and current liabilities account, plus depreciation. Cash provided or used by investing represents the money that the company has invested in the purchase of property, plant, and equipment, or the money the company has received because it has sold property, plant, or equipment. Cash provided by financing represents the money secured by the company for the issuance of debt or equity securities, or the money that has been paid out to purchase treasury stock or to repay debt that the company has incurred. Cash paid for dividends also appears in the financing portion of the cash flows. So this is a basic reconciliation between the beginning cash balance and the ending cash balance in the checking accounts.